I'm so glad you're with us on this Monday. We're watching possibly for some records, and we have some great guests for you. As U.S. stock index futures are looking to the upside. We're getting you ready for the trading day. We bring in Wall Street veteran Ted Weisberg, founder, president, Seaport Securities, and he has picked notoriously many winners over the years, and you've been on this trading floor for many years. How are you feeling about the market today, Ted?
Well, I'm still feeling good, but this week it's all about the Fed. You know, we have a Fed meeting Tuesday and Wednesday. We'll get the results Wednesday. The futures are telling us we're going to get an interest rate cut, 25 bips. Some people are saying 50. I hope it's 25. But one way or the other, it looks like an interest rate cut is pretty much baked in at this point.
So you would like to see 25, not 50. How will that help?
Well, 25 is probably baked in, and the problem with 50 is if it's 50, then the message to me is more negative than any of us assume. Perhaps they see some weakness in the economy that we, quite frankly, are not aware of. I don't think it's there, and I think a lot of the cut in rates perhaps is more political than necessary, but it is what it is. And overall, the market wants to see lower rates, so I think it's a positive backdrop for the market going forward.
Do you feel like the market can continue to move higher or melt up? We've been hitting records.
Well, I would simply say that, in my opinion, what I've learned over the years, and it's been many years, is that the market never, ever lies. The market in general, is a forward-looking indicator, not a trailing indicator, and it tends to discount the future, not the past. And I think the market is simply telling us, Nicole, the strength in the market is telling us that corporate earnings are going to remain robust going forward, and at the end of the day, it is all about corporate earnings, not about anything else, that ultimately will drive the stock market.
And ultimately, you've picked some real winners over the years. I mean, Meta was always one of your darlings that you went after right out at the IPO. What an incredible run it's had. Do you still like a name like Meta?
Yes, we basically, with one exception, we own every share we bought 10 years ago. And, perhaps we're being greedy, but I actually think the stock is going to work higher. And if new clients come into the firm and Meta is priced at some sort of discount, we would probably add.
So right now, the high was 796 and change, and right now it's at 755. I mean, do you think this could continue to go higher, break those highs, make new ground in the next, year or two?
Well, I guess the short answer is yes, otherwise we'd probably be selling some of the stock.
Yeah.
So we're comfortable with the stock.
Right.
We think it's a reasonably priced, a very high profile tech name. That and perhaps Google are two stocks that I think should be, in at least with exposure to tech, should probably be in every portfolio.
You know, another name that you picked, another name you picked was Essilor Luxottica. They make the glasses and Ray-Ban glasses, and then they had all these deals for, glasses with all kinds of special tricks. And this stock has been up over 30% in 1 year. It's a name that you've loved for a long time. Now what? Do you take profits or you stick with it?
No, we're going to stay with it because we think actually, it sounds pretty boring because we don't really sell anything. And if we get into a good name, we tend to keep it.
Yeah.
But this is a very unique company, and because it's one of the, it's a perfect example, in my opinion, of a vertically integrated corporate structure. You know, Luxottica merged 5 or 6 years ago with Essilor, which is a French company. They make the lenses. Luxottica makes the frames, and of course, and now they're into a lot of different things. Lens crafters in the U.S. I think they have 6,000 or 7,000 outlets. They own Sunglass Hut. I mean, it's a very interesting company. It's not a tech name, but it is a name that is a sector killer in their space.
And it's gone from, over 3 years, it's gone from $66 up to $160. So what an incredible pick that was. What else is on your radar? I know you've talked about Oracle, Chubb. What else do you still like?
Well, you know, now I think
Oracle, great pick.
Yeah. Well, you know, it's been a little bit of a struggle, but we had a good day last week. We've given some of that move back, but the stock's looking up again today. I mean, Oracle's a terrific company, but going forward, there's a couple of things that we're focused on. Number one, with the prospect of lower interest rates, which seems like a reasonably good bet at this point, we're focusing on, believe it or not, dividend-paying stocks. because as interest rates come down, those companies that pay generous dividends, and some more generous than others, become more desirable, and it'll tend to have dollars flowing into those sectors, which should, number one, you'll get the dividends, and number two, there's a good chance for some price appreciation. And one of the areas to look at, which is completely out of favor, are the big pharmaceutical companies, Pfizer, Bristol, Merck. Just as an example, I'm not suggesting any one of those names is a name you want to own, but there's a perfect place to go to get generous dividends with companies with good balance sheets, that are at the moment out of favor, but hopefully, with the benefit of time, will do better. And with interest rates coming down, those big dividends will tend to support the price of the stock.
Yeah, and I mean, some of the Vanguard has a lot of dividend ETFs, and also you have Schwab U.S. Dividend Equity ETF, SCHD, the Vanguard one, VIG, and iShares DJ Dividend DVY, so in the S&P Dividend SDY. So you can take a look at some of those different ETFs for dividend players. Correct. Overall.
But I think it's something folks should pay attention to, especially in an environment where interest rates are going to be lowered.
And then what about President Trump saying, trying to stop quarterly reports for companies, thinking that it distracts management and that they should do this biannually, twice a year rather than 4 times a year? What do you think of that?
Well,
as somebody who's an investor and shareholder, is that okay for you?
Well, I think it's a double-edged sword. I think on the surface, it would tend to take some of the volatility out of the market. And clearly it would take a lot of pressure off of corporate America to keep trying to hit these numbers. On the other hand, the fact that they know they have to report quarterly makes everybody get refocused all the time on, well, hopefully doing a better and better job. But management, I think, overall needs the benefit of a longer timetable for the earnings. So I actually would support that. I think it makes companies' life a lot easier, and I think actually it would benefit investors because it would take some of the quarterly volatility out of the stock market. So you would support
that. Very interesting, Ted. Well, thank you for being here on the very first show. Looking dapper. We appreciate it. Ted Weisberg, founder, president, Seaport Securities. Thanks for being here, Ted, always.